Hi everyone, it's Ava and welcome back to Your Financial Journey. In today's video, we're going to talk about interest rates, one of the most powerful forces in personal finance. Interest rates influence not only how much we pay for our homes or how expensive it is to carry credit card debt, they also define the returns we earn on our savings and whether we should invest in stocks or bonds. And for the economy as a whole, interest rates are a key tool for managing and fighting inflation, meaning that they impact the prices of our everyday purchases. Yet for all their importance, the way interest rates are set and how different types of interest rates function can be a bit mysterious and confusing. So let's take a deeper look into how interest rates are set, the key benchmarks that guide them, and why they matter in our everyday financial lives. The federal funds rate, or Fed funds rate. At the core of the U.S. interest rate system lies the Fed funds rate. And you may have heard about it before, because this is usually the rate that people mean when they discuss things like interest rates are up, or when will the Fed lower rates? The Fed funds rate isn't a single number, but a target range, say between 4% and 4.25%, or between 4.25% and 4.5%. It's set by the Federal Open Market Committee, the FOMC for short, which is part of the Federal Reserve. The Federal Reserve is the central bank of the U.S. and is also often referred to as the Fed. The FOMC normally meets 8 times a year to assess the health of the U.S. economy and to decide whether to raise, lower, or hold steady the target range for the Fed funds rate. The decision-making is based on indicators such as inflation, particularly the Consumer Price Index and the Personal Consumption Expenditures Index, as well as employment levels, GDP growth, and consumer sentiment. Now, technically, the Fed funds rate is the rate that banks charge each other for overnight loans of reserve balances, meaning when Bank A lends Bank B a bit of money for just one night. But even though the Fed funds rate, strictly speaking, applies only to this interbank lending, this overnight lending between banks, it forms the basis for nearly every other interest rate in the economy. For example, if you're planning to buy a new car, the cost of your auto loan will directly or indirectly depend on where this rate stands. A hike in the Fed funds rate can raise the average interest on auto loans, and a cut can reduce it. Similarly, a higher Fed funds rate might translate into higher yields or returns on savings accounts and CDs, encouraging people to save more rather than spend more. And a cut in the Fed funds rate might have the opposite effect and discourage savings, but encourage spending. In this way, the Fed uses interest rates to influence economic behavior, cooling down spending and borrowing when inflation is high, or encouraging spending and borrowing when the economy hits a slow patch. Let's move on now to the next rate that you'll often hear about, the prime rate. One of the most direct links between Fed policy and consumer borrowing comes through the prime rate, which is the interest rate banks charge their most credit-worthy corporate clients. Although each bank sets its own prime rate, it usually adjusts this rate based on where the Fed funds rate is, typically around 3 percentage points above it. That matters to everyday consumers, like you and me, because many of our credit products, like for example credit cards, home equity lines of credit, and some student loans, are tied to the prime rate. Say, for instance, that the prime rate is 8% right now, and that you have a credit card that charges you an APR, or annual percentage rate, that's equal to prime plus 10%. This means that you would pay 18% on your outstanding credit card balance, the prime rate of 8% plus a 10% add-on. And if the prime rate increases by half a percentage point, from 8% to 8.5%, then your credit card APR automatically goes from 18% to 18.5% as well. And that half a percent hike makes carrying a balance more expensive, possibly adding hundreds of dollars in interest payments over time. Similarly, a homeowner with a home equity line of credit may see their minimum monthly payments rise as the prime rate climbs. These incremental changes can significantly affect cash flow and budgeting for families. In addition to consumer loans, the prime rate also plays a crucial role for small businesses. Many loans to small businesses are priced using the prime rate as a benchmark, with some margin added on top. Just like for credit cards, although the add-on margin for small business loans is usually not as big as it is for credit cards. Regardless, though, if rates increase, it becomes more expensive for business owners to borrow the money they need to fund their operations, purchase inventory, or invest in expansion, potentially slowing growth or forcing price increases that get passed on to consumers. Do note that there are other benchmark interest rates out there, such as the SOFR, the Secured Overnight Financing Rate. We won't go into detail on this in today's video, but let's just say that they function, in principle, very similarly to the prime rate, meaning these other benchmark interest rates are ultimately based on a central bank rate like the Fed funds rate, with an extra margin added on to set a rate that the banks then charge to their borrowers. And finally, there is the 10-year Treasury Yield. The 10-year Treasury Yield is the annual return that a 10-year Treasury would give to an investor if it's bought today and held to maturity. In that sense, it's very similar to an interest rate. It measures a financial return. But it is not an interest rate in the traditional sense, because it's not set by the central bank. It's not set by the Fed. And this is because the 10-year Treasury Yield is the result of market forces, of the prices at which hundreds and thousands of traders buy and sell treasuries on the exchanges. The factors that directly and indirectly impact the 10-year Treasury Yield include the Fed funds rate, which we discussed earlier, inflation expectations, and investor demand. And maybe it's because of the way that the 10-year Treasury Yield is determined, by the collective wisdom of the market, so to speak. Perhaps that's why it's widely seen as a good yardstick for measuring borrowing costs in the U.S. economy. In fact, many bankers simply call the 10-year Treasury Yield the benchmark rate, because it very often forms the basis for the rates of many financial products that directly influence our lives, like home mortgages, for example. And like for other benchmark interest rates that we discussed before, even a small shift can have a big impact. For instance, even a 1 or 2% increase in interest on a 30-year variable rate mortgage can possibly raise your monthly payment by hundreds of dollars. Treasury yields are also important because they serve as the baseline, risk-free rate in the financial system. The rate that people expect to earn when they invest their money into something without risk. Because when investors buy treasuries, they expect the U.S. government to pay them their interest and to repay their principal on time. Understanding the Fed funds rate, the prime rate, treasury yields, and how all these rates are interlinked also sheds light on more subtle effects. For example, rising rates are bad for borrowers because they'll have to pay more on their credit card balances and new loans. But at the same time, rising rates may be good for savers who have their money in high-yield savings accounts, and for investors who buy new bonds and CDs because they will earn more. In practical terms, interest rates can affect how much you pay in interest on credit card balances, car loans, and personal loans, whether it's a good time to refinance your mortgage or lock in a fixed-rate loan, how attractive savings accounts and certificates of deposit are, the return you can expect from conservative investments like bonds, how attractive bonds look compared to equities. So to summarize, the Federal Reserve sets the federal funds rate to steer the economy. The Fed funds rate then forms the basis for the prime rate and indirectly the 10-year Treasury yield, as well as for other interbank and market-based rates that are beyond the scope of this video. Those rates, in turn, affect borrowing costs for consumers, the availability of capital for businesses, and returns on savings and investment products. By understanding this system and the relationships between its components, individuals and households can make smarter decisions about borrowing, saving, spending, and investing. Okay, my financial friend, I hope you found this video helpful. And if you want to learn more about the rates that you're charged for borrowing versus savings, then check out my sister Caitlin's video here on APR versus APY. Thanks for watching, and we'll see you again next time.